Most people believe there is always a reset button. When something breaks in the economy, central banks step in. They cut rates. They inject liquidity. They stabilize markets. And for decades, this worked. But what if the next crisis is different? What if the tools that saved the system before no longer work the same way? This video is not about predictions. It's about constraints. Because every system eventually reaches a point where adding more control creates less stability. And that's where global finance is quietly heading. Central banks were designed for a simpler world. Their original job was narrow. Control inflation. Stabilize currencies. Act as a lender of last resort. They were never meant to manage asset bubbles, government debt explosions, globalized capital flows, political pressure. But over time, expectations changed. Markets began to assume central banks would always step in. Every crisis reinforced that belief. When markets fell, rates were cut. When credit froze, money was injected. When confidence broke, promises were made. This created a dangerous assumption that central banks are not just regulators, but saviors. The problem is not that central banks failed. The problem is that they were asked to do too much, for too long. And systems that stretch beyond their design limits do not collapse suddenly. They lose effectiveness first. That is what we are seeing now. For most of modern economic history, interest rates were a reliable lever. Raise rates, borrowing slows. Lower rates, spending increases. Simple. Predictable. Effective. But that relationship only works under one condition: that debt levels are manageable. And that condition no longer exists. The world changed quietly. Over the last 2 decades, global debt didn't rise gradually. It accelerated. Governments borrowed to stabilize crises. Corporations borrowed to boost returns. Households borrowed to maintain living standards. Low interest rates made this possible. Cheap money didn't just stimulate growth. It reshaped behavior. Entire economies were built assuming rates would stay low forever. That assumption is now the problem. Why raising rates no longer fixes inflation cleanly? When central banks raise rates today, they face a dilemma. Higher rates are meant to slow inflation. But higher rates also increase government interest payments, stress highly leveraged companies, raise household debt burdens, threaten financial stability. In the past, these side effects were manageable. Today, they are systemic. A small rate increase ripples through housing markets, bond markets, banking balance sheets, government budgets. Instead of cooling the economy smoothly, rate hikes now create fracture points. So central banks hesitate. Not because they don't understand inflation, but because they understand the consequences. The trap of expectations. Markets still expect central banks to act decisively. But central banks know that decisive action carries growing risks. This creates a credibility gap. If they raise rates too much, something breaks. If they don't raise rates enough, inflation persists. Either path weakens trust. And once trust erodes, policy becomes less effective. Interest rates don't just work mechanically. They work psychologically. They rely on belief. Belief that central banks are in control. Belief that sacrifices today lead to stability tomorrow. That belief is harder to sustain when outcomes feel worse either way. When policy becomes reactive instead of preventive. Another quiet shift has already happened. Central banks are no longer shaping the future. They are reacting to damage. Instead of preventing bubbles, they clean them up. Instead of smoothing cycles, they respond to shocks. This changes how markets behave. Participants take more risk, assuming intervention will follow. That risk accumulates faster than policy can counteract. It's not recklessness. It's adaptation to a system that taught people intervention is guaranteed. Until it isn't. When confidence becomes the only tool left. At this stage, central banks are no longer relying mainly on policy. They are relying on belief. Belief that inflation will come down. Belief that markets will remain orderly. Belief that nothing critical will break. This is where modern monetary systems quietly shift. From control to narrative. When interest rates lose precision, communication takes over. Statements matter more than actions. Press conferences move markets more than data. Hints become signals. This is not accidental. Central banks know that expectations shape behavior. If people believe inflation will fall, they spend differently. If businesses believe stability will return, they delay layoffs. If investors believe support is coming, they keep capital in the system. So confidence becomes a policy tool. But confidence is fragile. Why credibility is harder to maintain now? In earlier decades, central banks had room to maneuver. They could tighten aggressively. They could loosen decisively. Today, every move is constrained. Markets see this. When officials say they will keep rates high for as long as necessary. But reverse course months later, credibility erodes. Not because they are incompetent, but because the system no longer allows clean follow-through. Once people notice this pattern, language loses power. And when language loses power, volatility increases. The feedback loop nobody talks about. Here is the quiet loop forming underneath everything. Markets react to central bank signals. Central banks react to market stress. Markets learn this behavior. Risk increases again. Each cycle weakens the original signal. Over time, policy stops leading. It starts following. This is how control slowly slips without a single dramatic moment. Why this feels like stability? To most people, nothing looks broken. Banks still operate. Markets still open. Jobs still exist. That is the illusion. Stability is being maintained through constant intervention and reassurance. Like a machine that only runs if someone keeps adjusting it manually. It works. Until it doesn't. The cost of delayed consequences. When systems rely on confidence alone, consequences don't disappear. They stack. Imbalances grow quietly. Debt rolls forward. Risk concentrates. The longer the delay, the sharper the adjustment later. This is not a prediction. It is a structural pattern repeated across history. When policy stops preventing damage and starts managing it. By the time the system reaches this stage, the goal has changed. Central banks are no longer trying to prevent stress. They are trying to control how stress unfolds. This distinction matters. The shift from prevention to containment. Early in a cycle, policy aims to smooth outcomes. Later, policy aims to slow consequences. Liquidity is added selectively. Rules are bent quietly. Exceptions become normal. Nothing is announced as an emergency. That is intentional. Open panic would accelerate the very outcomes they are trying to delay. So everything is framed as temporary, technical, and contained. Why slowdowns replace crashes? Modern crises rarely arrive as sudden collapses. They arrive as long periods of stagnation. Hiring freezes replace layoffs. Wages stall instead of falling. Living standards erode quietly. From the outside, this feels manageable. Central banks are often described as all-powerful. In reality, they operate inside limits that grow tighter with every cycle. Their tools still exist. Their influence still matters. But the system they manage is larger, more indebted, and more fragile than it was before. Understanding these constraints does not predict the future. It explains why outcomes feel slower, quieter, and harder to escape. This channel exists to explain how global economic systems actually work beneath the surface. No advice. No hype. Only structure and incentives. If you value calm, long-form explanations about money, debt, and systemic risk, consider subscribing. New videos are released regularly. From the inside, it compounds stress over time. People adjust expectations downward, one step at a time. This is how systems absorb damage without dramatic headlines. The real constraints central banks face. Central banks can influence prices. They can influence liquidity. They cannot restore purchasing power once it is lost. They cannot reverse demographic pressure. They cannot undo accumulated debt. At this stage, every policy choice involves trade-offs. Stability versus growth. Inflation versus employment. Credibility versus intervention. There are no clean solutions left. Only managed outcomes. Why this phase lasts longer than expected. Once a system enters this mode, it tends to stay there. Reversing course would require accepting visible pain. Visible pain has political consequences. So the system chooses gradual adjustment instead. This creates a long middle period where nothing collapses, but nothing truly recovers either. People feel stuck. That feeling is not accidental. It is the cost of keeping the system intact. The quiet end of the cycle. Debt eventually resolves. It always does. Sometimes through growth. Sometimes through inflation. Sometimes through restructuring. But rarely through clean repayment. By the time the resolution becomes obvious, most of the adjustment has already happened quietly. The shock feels sudden only in hindsight. This is not about predicting disaster. It is about understanding why systems behave the way they do when limits are reached. Central banks are not powerless. They are constrained. And when constraints tighten, outcomes become slower, quieter, and harder to notice. Until they are impossible to ignore.